For decades, the world has lived inside a quiet agreement that was never formally signed, never publicly debated, and rarely questioned. An agreement built on the belief that debt could expand forever without consequence, that promises written in currency would always be honored by future growth, future taxpayers, future stability. That agreement is now fracturing, not with a single collapse, not with a dramatic announcement, but with a slow, irreversible unraveling that history has seen before and never ended gently. Every major economic era ends the same way, not because people fail to innovate or trade or produce, but because systems built on leverage eventually collide with reality. Empires do not fall when they run out of money. They fall when their money no longer means what it once did. Today, beneath the surface of markets and headlines, the global debt structure that powered decades of expansion is reaching its limit, and the mechanisms that once sustained it are no longer working the way they used to. This is not a story about a sudden crash or a single villain. It is a story about cycles, incentives, institutions, and choices made repeatedly over generations. It is about how debt became the foundation of modern power, how it reshaped geopolitics, and why the very tool that built the modern world is now beginning to close in on it. To understand why this moment matters, it helps to step back from daily market noise and see the scale of what has been built. Global debt today sits at levels that would have been unthinkable for most of modern history, surpassing multiples of global economic output, embedded not only in governments but in corporations, households, and financial institutions. This debt is not abstract. It represents future claims on labor, resources, and political stability. And as interest rates rise, demographics shift, and growth slows, those claims become harder to fulfill without consequence. What makes this moment different is not simply the amount of debt, but the exhaustion of the tools designed to manage it. For decades, policymakers relied on a familiar playbook: lower interest rates, currency expansion, financial engineering, and global coordination. Each crisis was met with more liquidity, more leverage, and more confidence that growth would eventually outrun obligations. That strategy worked longer than many expected, but history shows it never works forever. To see where this road leads, we have to rewind. After the First World War, Europe was buried under obligations that could not be paid as structured. Germany's reparations were financed through borrowing and monetary expansion, a decision that led to one of the most documented inflations in history. The collapse of the mark in the early 1920s was not caused by chaos alone, but by an attempt to meet impossible debt commitments through currency creation. The lesson was clear, yet repeatedly ignored. When debts exceed productive capacity, money itself becomes unstable. The Great Depression followed a similar pattern on a global scale. Excess leverage, speculative credit expansion, and fragile banking structures created a system that appeared prosperous until confidence broke. What followed was not just an economic downturn, but a restructuring of how money and debt were managed. The creation of institutions like the International Monetary Fund and the World Bank after World War II was a direct response to these failures, designed to stabilize currencies, coordinate policy, and prevent competitive collapse. The post-war order worked because it aligned debt with growth, demographics, and industrial expansion. The United States emerged as the anchor, its currency backed by productive dominance and, initially, gold reserves. The Bretton Woods system imposed discipline, not perfection, but enough constraint to keep debt from overwhelming the system. That discipline began to erode in the late 1960s as war spending, social programs, and trade imbalances strained the gold link. In 1971, when the United States suspended gold convertibility, the world quietly entered a new era. Currencies were no longer tied to hard limits but to confidence, policy credibility, and geopolitical power. This shift allowed unprecedented flexibility, and with it, unprecedented debt expansion. Governments could borrow more easily, financial markets could grow faster, and global trade could scale without the constraints that had defined earlier systems. Over time, debt stopped being a temporary tool and became a permanent feature. The rise of the Eurodollar system, offshore banking, and complex derivatives expanded credit far beyond domestic controls. Institutions like the Bank for International Settlements documented this growth not as an anomaly, but as a structural transformation. Debt was no longer cyclical, it was embedded. Each crisis reinforced the pattern. The Latin American debt crisis of the 1980s, the Asian financial crisis of the late 1990s, the global financial crisis of 2008 all ended the same way, with balance sheets expanded, interest rates lowered, and assurances that lessons had been learned. But the underlying structure remained unchanged. Losses were socialized, leverage was rebuilt, and the total stock of debt moved higher. What changed after 2008 was scale. Central banks moved from lenders of last resort to dominant market participants. Quantitative easing was not a temporary measure but a structural response to a system that could no longer function under normal interest rates. The Federal Reserve, the European Central Bank, and the Bank of Japan all expanded their balance sheets to stabilize markets and governments simultaneously. This was not ideology, it was necessity. The mechanism was simple but powerful. By suppressing interest rates, policymakers reduced the immediate cost of debt, allowing governments and corporations to roll over obligations rather than repay them. Growth, asset prices, and financial stability became interdependent. Any attempt to normalize policy risked triggering instability, while continued easing deepened dependency. This is the essence of the debt trap. Once a system reaches a certain level of leverage, it cannot easily exit without pain. Raising rates increases defaults and fiscal stress. Keeping rates low erodes currency value and distorts capital allocation. The trap is not intentional, but it is real, and history shows that it always resolves through restructuring, inflation, default, or a combination of all three. Today, the parallels are impossible to ignore. Aging populations in advanced economies are reducing growth potential just as debt servicing costs rise. Geopolitical fragmentation is reversing decades of globalization that once supported efficient production and low inflation. Sanctions, trade realignments, and reserve diversification are changing how currencies function in international settlements. Even institutions like the IMF have acknowledged that the era of cheap money cannot return without consequence. Behind the scenes, incentives remain misaligned. Governments prefer inflation to austerity because it quietly reduces real debt burdens. Financial institutions benefit from asset inflation supported by liquidity. Political systems reward short-term stability over long-term restructuring. None of this requires conspiracy, it emerges naturally from how modern systems are designed. As interest rates rose in the early 2020s, cracks began to appear. Sovereign debt sustainability came under renewed scrutiny. Banking stresses re-emerged in institutions holding long-duration assets. Currency volatility increased, particularly in economies reliant on external financing. These are not isolated incidents, they are signals. The acceleration phase of this cycle follows a familiar historical pattern. Debt grows faster than income, policy options narrow, and shocks that were once manageable become destabilizing. History shows that once confidence in the future purchasing power of money weakens, behavior changes rapidly. Capital seeks safety, governments face pressure to intervene, and the line between monetary and fiscal policy blurs completely. The revelation at the heart of this moment is not that debt is bad or that collapse is inevitable, but that systems built on perpetual expansion eventually reach a boundary. The debt trap does not end because leaders choose to end it. It ends because reality imposes limits that policy cannot override indefinitely. What comes next is not a single outcome, but a transition. Some debts will be restructured quietly through inflation. Some institutions will fail and be absorbed. Some currencies will lose influence while others gain. The process will be uneven, political, and contested, just as it has been in every previous cycle documented in economic history. The debt trap is ending not with a bang, but with a shift in power, incentives, and assumptions. Those who understand the pattern are not predicting catastrophe. They are recognizing a transition that has occurred many times before. History does not repeat perfectly, but it rhymes closely enough to be recognizable to those willing to look beyond the present moment. And as this era closes, the most important question is not how much debt exists, but who ultimately bears its cost, and how societies choose to redefine value, money, and stability in the world that follows.